Hey guys, Freaky Finance here. Got a bit of a cold this week, a little bit of cough, so bear with me as I go through this. Today we're kicking it back into Canada. There's some decent things in Canada. America kind of shot up year to date and left quite a bit of positions in Canada fairly cheap. A lot of these have to do with interest rates. They're taking a chunk out of earnings for a lot of companies, these higher rates, and TransCanada Energy is one of them. Now this one's very interesting. I did just buy this one, so I want to do the video out. Still could get cheaper, but it's at a decent spot now, in my opinion, and 7.7% div yield. I did an Enbridge video. It's a very similar play with some differences, but I mean, I'll link the Enbridge video at the end of this video just for history. It's been a while. I think I did that one around the pandemic, just because I was getting hit. It was going down with oil prices, which was funny to me. Anyway, and there's also Enbridge has a Line 5 drama, which always seems to rear up over and over again. Anyway, so today we're just going to do TransCanada Energy. It's a fun one, and they have some good visuals with their recent spin-off announcement. So, I won't spend too much time on this. I kind of went more into this detail on the tariffs for Enbridge, but it's the same idea. So, pipelines are really like, they're like utility with higher ROE, so higher allowable returns on equity. The difference here is that usually the regulator is a federal body instead of a provincial body or a state body. So instead of like the regulator of Alberta or BC, the regulator for Canada for pipelines, because pipelines go across different jurisdictions. You can see here that they have a allowed ROE of 10% based on a 4% deemed common equity. And the more by equity, usually the higher the ROE. So if this was 50, this number would probably be higher. Then you have the Canadian mainline as well. We won't go. We'll see them briefly, but there's really one reason why I'm liking this one right now, aside from the price, which we'll also go into. But I just want to get the background. In America, it's the same thing. Obviously, different regulator, American regulator, so FERC, instead of a CER, which is Canadian. But it's the same idea. Basically, it's regulated because pipelines are usually a natural monopoly, right? There's not going to be able to competing pipeline beside another pipeline and cut the price. Race to the bottom. Pipelines are also very capital intensive, and you'll see that as we go through as well. Hopefully, if I do a good job. This is probably a pretty good slide just to see the breakup between the two divisions. So they are going to do they're going to vote for a spinoff, but you can see TransCanada Energy, specifically Nat Gas, is here in the darker blue, and then the teal is the liquids pipeline company. And you can see overall they have decent CAGRs. The Nat Gas has a better growth CAGR than the pipelines business. That's your keystone down here. But overall, you can see a pretty steady, slow growth profile over time. That's been true for this company for a while now. So anyway, I like this because it kind of shows the size differential. So it's 85%, I'd say, gas pipelines, and then 14% liquids pipelines. The gas pipelines further breaks out. So you have, say, 85% gas, and that 85% gas breaks out into really three parts. So you have Canada, which is a third, US, which is about 50%, and Mexico, which is about 10%. We won't talk about the power and energy solutions. It's just small for the purposes of today's video. But anyway, it kind of helps set the frame. And this is another good visual. This is the whole network, so it's the gas and the liquids pipelines. More importantly for this slide, I just like to point out so right here you can see this dotted line. That's pipelines under construction. So that's the Coastal Gaslink. And that's the main reason why I'm excited about this company, aside from the price, is here. It's also a reason why the price is as cheap as it is, probably. And then you have the Mexico one down here as well. And so again, the dark blue is gas pipelines, and the teal is the liquids pipelines. So on the gas pipelines, you can see what I mean by utility is it's very predictable. Aside from being regulated, it's very predictable cash flow. Here you have 96% of the EBITDA underpinned by regulated and long-term contracted assets. So that's nice when you have a fairly good idea of what your cash flow is going to be. Even if, say, oil pulled back, you still have a decent idea of the volumes. Pipelines, generally, they can do some marketing, but generally they push through commodity flows. So if commodity prices rise or decline, they generally don't participate much. Unless they have storage, and even then usually it's a smaller part of their business, so it doesn't move the needle that much. It can if the prices are very high, if they swing very high year over year, but usually it's a fairly steady utility play. Usually that's what pipelines are. until someone blows them up. Here's a liquid, so a lot less going on the liquid side. It's very small, so I am kind of surprised they are splitting up given how small it is relative to the other business. You would assume that the access to capital, so when this company is by itself, it's probably going to be harder for it to get financing. And we'll talk about financing is one of the reasons, or interest rates are one of the reasons why this company is getting cheaper, in my opinion. So anyway, you can see there's just 3 here. And Keystone's the large one. They have white spruce up here. It's going from Fort Mac to Edmonton. All right, so this is their numbers. I'm going to go through mine, but this is basically, if you really wanted to see what's going on, you can see EBITDA slow, steady growth for their 3 main divisions, as well as the liquids, so the nat gas. So far, year over year, you'd say the best outperformers Canada and then Mexico. A part of that is because they put in stuff that's in service that they didn't have in service this time last year. So they have basically easy comps because their pipelines are in service than they were last year. And that's the general theme. But I also want to point out, while the EBITDA is going up, you're seeing both depreciation, but you're also seeing interest expense going up by quite a bit. Right? So say here you have, let's call it 500 million. It's not quite, but just call it that. But you also have your interest expense going up by 350 million. So it's eating about 60% of the increase in EBITDA is going to debtors and not to common shareholders. And that's because 15% of their debt is floating. So it's the higher interest rates year over year are hurting them. How I like to do it my way is it's the same thing, but basically you can see really quickly, you can see operating margin going up. But you have the net interest expense also going up. So while operating margin's up, call it 200 million or so, you have interest expense eating 178 million year over year. Not exactly the same as their adjusted EBITDA numbers, but it's kind of the gap numbers linking to them to see if they pair up, which is always good for earnings quality reasons. But anyway, I'd say fairly steady. So basically what I'm trying to say is EBITDA growth is good, but the earnings per share growth is limited because the interest expense is so high, because of their 15% of their debt is floating up with higher interest rates. So now we have a share price that's actually gotten down quite a bit. I think it was over 70, I want to say May last year, and now we're in August this year. So it's come in quite a bit, like you're probably getting 30% off. From strictly speaking, a year ago, it's about 26% off. Now there is some dilution here because they have a drip. They had a drip, they just canceled it, which might be a reason for the pressure, but basically 38% of their shareholders were enrolled in the drip, which technically it saves them cash outflow, but it also dilutes the existing shareholders that aren't participating in the drip and prospective shareholders like me. So anyway, I'm actually glad that they canceled it, but some people might not be. Anyway, in terms of equity EV, you're about 23% cheaper. What else is there? Debt's slowly going up. So one of the things that's happening is because there's so much CapEx, they have Coastal Gaslink that's coming up, which has been fairly steep in terms of CapEx spend. A couple other projects coming up. We'll go through them really quick too in a bit, but really you're seeing debt tick up because they can't cover the CapEx with the cash from operations. While at the same time they're paying a dividend, like I think I showed you guys this, 7.7% dividend yield has to come from somewhere. So right now, because their CapEx is so high, they have negative free cash flow, but they're still paying a decent amount in dividends. So they have to come from somewhere, and it's coming from debt. I should say it's also coming from asset sales from non-core as well. So they are doing some stuff. So it's not all that's hitting debt on the chin as they build this out. So that's some stuff to keep in mind of why it could be cheaper, right? So it's not as cheap as it looks because of partially dilution, partially from more debt, and because the fundamentals are improving on the EBITDA side, they're kind of getting eaten a lot of it with the higher interest expense. What this all means is that you see the operating income shoot up. One of the things that this always, I should say always, but usually out of the pipelines, the scale, the operating margin goes up, as how I calculate it anyway. Basically because you're just getting more and more revenue from in-service. And how you get that revenue, you don't have to incur too much more to generate it. So here you can see plant and OpEx. So while revenue went up, let's call it 200 million year over year, from 3.83 to, or 3.63 to 3.83, you can see that the cost of actually, the operating costs only went up 43 million. So I'm trying to say here, there's quite a lot of operating leverage in the business. But again, in order to get that operating leverage, you have to incur a whole lot of CapEx. So you see depreciation expense shoot up. And in order to fund the CapEx, you have to obviously have debt or equity, which also needs to be serviced. So you have interest expense going up. So that's kind of the game, I'd say. But the bigger you are, the lower your capital your cost of capital will be, which helps you over time. And interest rates also, if they actually go down instead of up like they have been for a while, will also help TransCanada quite a bit. What else is there? Here you can see the EBITDA up 4.4%. It's actually, they've guided to 5 to 7 for the year. They actually had better out of this because of Q1. It was very strong. And it's cheaper in terms of EV to EBITDA, and it's cheaper in terms of PE. So just because it's gone down so much, it's just cheaper. And the business fundamentally, from an EBITDA perspective, has improved. From an EBS perspective, it's kind of stuck because the interest expense is eating into it, as well as the depreciation expense. But anyway, my opinion, market's likely pricing at higher rates for longer. It's also probably pricing in the fact that Coastal Gaslink, well, it's 91% complete. They've been overrun, I think, twice now over budget, probably more than that. And they've also been over budget on time. So both those reasons, maybe the market's thinking they're going to kick it one more time to 2024. Then the cadence gets screwed over for EBITDA growth for a little bit longer. Because the quicker these things get in service, the quicker we can see the return of capital on them. So any more delays would probably put more pressure on the stock, which the market may be trying to price in because it's probably increasing the probabilities because they've done it so often, so many times now. Especially this last push might be we'll see though. Who knows? Here's the in-service one. So these are basically the catalysts for more EBITDA improvement each year. And you can see Coastal Gaslink is the big one here. Estimated project cost 5.4, and they're done 91% of it. So when this goes into play, it's going to be a big kick up in EBITDA for these guys because they've already incurred all this cost. This is the one that they're riding right now, and they're still riding it. This is one of the reasons why the EBITDA is improving as we speak year over year, as well as Mexico. We've seen this one's going to complete too. I know they did a part of it last year in September, so they're finishing this part this year. So anyway, those are the reasons why the EBITDA expands is basically when they get projects in service. And they have quite a few. What I'm trying to say here is they have quite a few in 2023, which means 2024 is going to have very easy comps, assuming they're done on time. And then 2025 should also have easy comps because they have a decent amount in 2024 as well. So you're going to see a pretty good growth cadence in EBITDA. At the same time, I thought this statement, I always read Brookfield's shareholder review. I also own Brookfield. I don't think I did a video on them, but anyway, their shareholder is always pretty good. Anyway, this line here kind of stuck with me, so I wanted to share it here because it applies to a lot of companies. That they're applying this to real estate, but I'm applying it to TransCanada pipelines because why not? But anyway, they say it's important to remember that interest rates increase once, but rental rates keep increasing forever. Here you can say, well, we only incurred the cost of the pipeline once. Interest rates have spiked up this year over year. Do you think they're going to spike up by the same rate again next year? And I'd say no, they're not going to go from 2 to 5 to 5 to 10, right? God willing. So anyway, I think what's going to happen is you're going to see that interest expense plateau. It's not going to, I don't think they're going to cut rates. Well, maybe they will, who knows? But I don't think they will. Usually, it was like Brazil. Brazil got 12 months straight of downwards inflation, like crazy, and they kept rates at 13% forever. Now they're finally cutting, like a year later. I expect a lot of central banks to be very slow on reducing interest expense. Even if they should. Even if they're flat for a while, just the rate of change, you're going to see EBITDA keep ticking up, and you're going to see the interest expense year over year finally flatten out. Won't be this year, but it should be next year. Anyway, here's me. I think I was just trying to show you guys that it is 91% complete, so I'm not just spitting numbers at you. They do say that's 98% of the pipe's been welded, 92% is all classified water holdings, project now complete, and 640 clicks of the 670 pipe has been installed and backfilled. So quite a bit. They also do have Southeast, which is another one that's going to happen later on. I think the in-service date there, Southeast, 2025. So that's the next one for 2025 into 2026. But you get this nice cadence of EBITDA growth is what I'm trying to say. And that's another big one. You can see 4.5 billion estimated project cost. Almost as big as Coastal Gaslink was. Here you can see Coastal Gaslink just because I like to see them. Because this is the catalyst to why I like to buy it. Not only is it cheap, but it has the EBITDA growth profile. Assuming it's done, right? On time and on budget, which it hasn't been so far. But anyway, basically going from the mountains to the ocean to the LNG terminal, I'm pretty sure. Yeah, in Kitimat. Probably right here. Just access to the water. And then out to sea. For the Americans, it's actually pretty close to the bottom part of Alaska right here. Because you guys have this random little foot coming in to get all these islands, I suppose. Anyway, this is them being over budget, so they're over budget here. Said on Wednesday that it increased their Coastal Gaslink expected cost to 14.5 billion, up another 30%, and it's up 130% from the original one in 2018, 6.2 billion. So you can see it's they've had issues with cost. That's another thing if you're competing with Enbridge. So regulators are cost recovery, so the more their costs are, the more they have to charge. So it's likely Enbridge's mainline is going to be cheaper, which means the volumes on Enbridge will still be pretty high. So it'll be what I'm trying to say here is that'll be this one. That'll be more of who's left over. We'll use this pipeline, right? Whereas Enbridge, I think, will still be partially cheaper because of these cost overruns. Or that's what I'm thinking. I don't know that, but that's what I'm thinking. Anyway, here you can see the share price going from 75 to 50. So it sold off pretty hard on these cost overruns. It's even selling off before them, and it's actually back down. It's actually cheaper than it was in 2018. Well, right around there now. But it dipped down and rejected it pretty quickly. A lot of people must have been buying, waiting for it there. But you can see it's pretty cheap. And it's been a slow growing EBITDA. Like I said, its utility profile is slowly growing each year. I'm bulking up in size and in debt. All these utility plays are like that, highly capital intensive. Here's just this low EBITDA growth going from, call it 1.5. Well, here's better. That's a weird number. Call it 3.8, 4.7, 6.1, 7.1. So it's been slowly ticking up. One of the things, I'll just end on this note. I'm trying to keep these videos tight, but here you can see nat gas plays, or nat gas in different hubs. So you have Henry Hub and the H and TTF in Europe, and then you have the Japanese Korean marker. And you can see what these pipelines are going to do, or what Enbridge's strategy is. And I'm more familiar with Enbridge because I've followed it for longer. Is basically they're getting the storage so they can make the spread on these things when they blow out. At least that's what I imagine. As all these renewable pushes happen, different continents are going to be more aggressive or less aggressive over time. And it's going to keep leading to these huge price gyrations like we saw when TTF in Europe last year, and the Japanese Korea marker as well, to a lesser extent. But you can see they're both still elevated. And you can see this is the reason why these pipelines are so important, because you can do the hub hopping with the natural gas and get the return, which easily covers the cost of transportation when the spreads are as high as this. And I think that's going to continue. I think what we saw last year is going to continue over time, especially as people push renewable energy when it turns out not to be as reliable as they hoped. They're going to need these a lot of storage in places ready to go and ship it and take the spread as it blows out. Anyway, that's just my thoughts. That's my thoughts on that gas as well. Anyway, that's TransCanada Energy. It's a pretty good one. There is the risk, obviously, if the cost overruns one more time, this thing's going to shoot down again one more time, hopefully, and then I can get a better position in it. But, I mean, it's 30% cheaper with EBITDA growing 5 to 7% a year. It looks nice, and at the same time, interest rates won't keep increasing at the same rate they just have. So, hopefully, that all made sense to you guys. I wanted to get this video up before the weekend. Anyway, have a great rest of your weekend.